chapter, but to take it a step further and compute depletion and depreciation on the mine and mine equipment using units of production. Alright, so what we did before is we calculated the cost of the copper mine, the purchase price, $2 million, development of the site, 600,000, and then if you were to look back in your notes, you would see that we calculated the asset retirement obligation using those three probabilities, using the present value tables. We calculated it to be 303,939. And so the total cost of the copper mine was 1,903,939.
What did you say ARO stand for?
I'm sorry?
You said ARO. How did you calculate?
Asset retirement obligation.
You said you calculated it using a chart?
Oh, yeah, we calculated using the present value tables. So we took the three probabilities. I don't have it on the sheet of paper, but we took 300,000 times 25%, 400,000 times 40%, 600,000 times 35%, and we got a total. It was like 435,000, and that was the value in the future. And so we used the present value tables where N equaled, I think it was 4 years, and I was 10%. We found that present value factor.
Mm-hmm.
We multiplied the 400 number by the present value factor, and it brought us to this number.
Okay.
And that's the present value of what we think we're going to spend in the future.
Is that going to be given to us, the ARO, in the...
If it's on the study guide, then it's being tested. I don't remember if it's on the study guide or not.
Okay.
So if it's on the study guide, then you have to know how to calculate it.
Will we be given the
Chapter 10.
chart?
Yeah.
I missed that day, didn't I? I sure did. I did. That was the day that the accounting project was due.
So you skipped class?
No, I did not skip class. I skipped both of them.
All right. So the calculation for that is in my notes for chapter 10.
Okay.
All right, so the focus of this chapter, though, is to take this number that we've capitalized, we put it on the balance sheet, and now we want to calculate depletion. And so we're going to use units of production. When you have natural resources, you typically use units of production. We'll calculate the depletion rate. Natural resources deplete. But the calculation is exactly the same for units of production. We've just changed the word from depreciation to depletion. We'll take the capitalized cost, and we'll divide by total estimated output. So the cost of the copper mine, 1,903,939. And they think that they're going to extract 10 million something of copper. 10 million pounds. The company expects to extract 10 million pounds of copper from the mine. So that gives us a depletion rate of 0.1904 per Volby. Once we know the depletion rate, then we can calculate the actual depletion for each year. In 2021, it says that actual production was 1.6 million pounds in 2021. Multiply that by the depletion rate, and we get total depletion of 304,630. So our journal entry, instead of recording depreciation expense, we record depletion expense. And then what's a little different with, natural resources, same for intangibles, that's different from PP&E, when you're talking about property, plant, and equipment, you always leave that account alone. It remains a cost, the fixed asset, and we have the separate contra asset, accumulated depreciation, and they work together to reduce it. With natural resources and intangible assets, we don't typically have that contra account, we just reduce the asset directly. So instead of crediting accumulated depletion, we'll just credit the copper mine. And then it also says to calculate depreciation on the mining equipment, and we're gonna use units of production for that as well. And it's depreciation, so we'll calculate the depreciation rate for the equipment. And the equipment had a salvage value, so we need to take that into account. They purchased it for $120. It has a salvage value of $20. But once again, we expect to extract 10 million pounds of copper. So we're still gonna use the same denominator to depreciate our equipment. So we get a depreciation rate of 100 divided by 10 million, or a penny per pound. In 2021, we extracted 1.6 million pounds. Multiply that by our depreciation rate, and we get $16,000 of depreciation expense. And we'll credit accumulated depreciation since we're talking about fixed assets.
How do you know that they were using continuous production?
Probably told us. It says it in requirement 1, compute depletion and depreciation on the mine and mining equipment. The units of production method is used to calculate depreciation. I don't know why it just said depreciation. It should say to calculate depletion and depreciation. Why does that? Other questions?
I know you said it, but can you say again why, for depletion, you don't, it's not accumulated? And instead just-
So GAAP is specific with fixed assets. You have to put it into accumulated depreciation. It's not specific when you get to natural resources and intangibles. You can put it to an accumulated depletion or accumulated amortization account. But in the real world, most people just reduce the asset directly and don't have that separate account. It wouldn't be wrong if you had that. Alright, let's look at some intangibles. Exercise 1119. Jane's company provided the following information on intangible assets. So what it wants us to do, just jumping down to the requirement, prepare the necessary journal entries. So as we go through each one of these, I'm gonna go ahead and do those journal entries. So it says in A patent was purchased from Lou Company for $700,000 on January 1st, 2019. January 1st, 2019, we purchase a patent for $700,000. And so we capitalize that cost, we make it an asset, we put it on our balance sheet, and we call it patent. Now, let me keep reading. James estimated the remaining useful life of the patent to be 10 years. The patent was carried on Lou's accounting records at a net book value of $350,000 when Lou sold it to James. Well, that's irrelevant, right? We're James Company. Doesn't matter what Lou had it for. We're just concerned about what we purchased it for, $700,000, and it's gonna have a useful life of 10 years. Now, when I get to B, we jump ahead to 2021, but there's some things that have to happen before we get to 2021. So December 31st, 2019, we need to record our amortization of the patent. So using straight line, we've got the cost of 700 divided by the useful life of 10 years, gives us amortization expense each year of $70,000. So we're gonna debit amortization expense. And just like with natural resources, we're going to reduce the asset directly. My numbers up a little better. So instead of having an accumulated amortization account, we're just gonna reduce the asset directly. We'll make this exact same journal entry again at December 31st, 2020. So times 2. Alright, so now we're up to B. During 2021, a franchise was purchased from the Rink Company for $500,000. The contractual life of the franchise is 10 years, and Jane reports a full year of amortization in the year of the purchase. So sometime during 2021, doesn't tell us the exact date, but that's okay. We purchased a franchise for $500,000. Assuming we pay cash. James incurred research and development costs in 2021 as follows: materials and supplies, personnel, and indirect costs for a total of $380,000. So also in 2021, we have some R&D. We do not capitalize R&D, instead we expense it. It is not an intangible asset. Effective January 1st, 2021, based on new events that have occurred, James estimates that the remaining life of the patent purchased from Lou is only 5 more years. All right, so we've got a change in estimated useful life, just on the patent. So we wanna recalculate the cost of the patent. So the original cost was $700,000. We have amortized, we have created this journal entry twice now. This journal entry reduced the patent by $70,000 each time, so it's reduced the patent by $140,000. We haven't yet recorded our December 31st, 2021 journal entries. unamortized patent of $560,000. We're gonna use this unamortized balance going forward, and the new useful life is 5 more years. So it didn't change it from 10 down to 5. If it had, then we would only have 3 more years. It said it has 5 more years at this point. So we're gonna divide by 5, new useful life. And that gives us amortization of 112. And so that'll be our December 31st, 2021 amount for our journal entry. So not the 70,000 anymore, now it's 112. Also at 12/31/21, we need to amortize this franchise. The franchise's useful life was 10 years. $500,000 divided by 10 years gives me amortization expense of $50,000. Requirement 2 says prepare a schedule showing the intangible asset section of Jane's December 31st, 2021 balance sheet. We've got intangible assets. We have 2. We have a patent and a franchise. There is no accumulated amortization account. The patent was first recorded at $700,000. We reduced it by $140,000, and then we reduced it by $112,000. So 700 minus 70 minus 70 minus 112 gets me to 448. And with the franchise, we recorded it at 500,000. We amortized 50,000, so it's sitting at 450. Our intangible assets is 898. So now you've seen journal entries with depreciation, with depletion, and with amortization. Typically, your natural resources uses units of production. Typically, your intangibles uses straight line.
So the part where we came up with the new amortization, what is that called again?
A change in estimate.
Like phase one?
In several of the chapters, it explained how to handle a change in an estimate on various different cover any of that in class. Couldn't get away from it because it was in the middle of this project, problem, but it's not something I test you on. Other questions? Alright, next topic is asset impairment. Looking at exercise 1127. Chadwick Enterprise, Inc. operates several restaurants throughout the Midwest. 3 of its restaurants, located in the center of a large urban area, have experienced declining profits due to declining population. Company's management has decided to test the assets of the restaurant for possible impairment. So the GAAP requires asset impairment tests. We must test assets for impairment. If an event or circumstances leads management to believe the assets may be impaired. Very vague, right? Something happens that make you think it might be impaired, then you test. So what this company has seen is a declining population causing declining profits, leading them to think that the assets in this restaurant probably have been impaired, so they've decided to do the impairment test. The relevant information: book value, $6.5 million, estimated undiscounted sum of future cash flows, $4 million, and fair value of $3.5 million. All right, so the asset impairment is a 2-step process. Step 1 is the recoverability test. And the question that we're looking at is the undiscounted sum of future cash flows less than book value. This is a yes or no question. It doesn't matter the difference, yes or no. The problem told us that book value was $6.5 million, and the sum of future cash flows is $4 million. Is the undiscounted sum of future cash flows less than book value? If yes, move on to step 2. If no, then no impairment. We're done. $4 million is less than $6.5 million, so the answer is yes. So we're gonna move on to step 2, which is the measurement. Is the fair value less than book value? Once again, we have a book value of 6.5 million. And a fair value of 3.5 million. So yes, the fair value is less than the book value. So we have an impairment of 3 million. So if we have an impairment, then I have to record that. I'm gonna debit an account called loss on asset write-down. And I would credit whatever the asset was. It's very vague here, we'll just call it restaurant. Assets. Obviously, if no, then there's no impairment. GAAP is conservative,
Sometimes I don't know
we
what
would
it is.
record a loss, but never a gain.
Sometimes I don't know. I thought we were best friends.
Requirement 2 says repeat requirement 1, assuming the estimated undiscounted sum of future cash flows is 6.8 million and fair value is 5 million. Requirement 2, undiscounted sum of future cash flows is 6.8 million. Fair value is 5 million. And book value stays the same at 6.5. Step 1, we compare book value to undiscounted sum of future cash flows. Something's wrong. What did I write wrong? 6.8. Thank you. 6.8 million. Book value, sum of future cash flows, no impairment. Even though, if we made it to step 2, we would have a write-down because fair value is less than book value. We don't even make it to step 2. We don't even care. The rule under GAAP says if the question is no, the answer to the question is no in step 1, then you have no impairment, you don't move on to step 2. I'll do one more that's similar to this because I think this one is more like your homework. This leaves out one little piece. So let's look at exercise 1130. Same topic. Corporation operates a manufacturing plant in Arizona. Due to a significant decline in demand for the product manufactured at the Arizona site, an impairment test is deemed appropriate. Management has acquired the following information for the assets of the plant. The cost is $32.5 million, accumulated depreciation is $14.2 million, and the estimate of total cash flows, is $15 million. Fair value of the Arizona plant is estimated to be $11 million. Alright. So, it doesn't tell us the book value. How can we figure that out? How do you calculate book value? Come on, guys.
Can you just do that?
Cost minus depreciation?
Cost minus accumulated depreciation. I'm gonna chalk that one up to your brains being fried because it's the end of the semester. So we've got cost of $32.5 million, accumulated depreciation of $14.2 million, so our book value is $18.3 million. Sum of future cash flows is $15 million. Is the undiscounted sum of future cash flows less than book value? Yes, so we're gonna move on to the second test. Book value is still 18.3. Fair value is given. The fair value of the Arizona plant is estimated to be $11 million. So we do have an impairment loss. When you're removing assets, the more appropriate journal entry, besides the one that I just erased, is that you have to remove both the cost and the accumulated depreciation related to your asset. So we have a loss of $7.3 million. Loss on asset write-down. $7.3 million. And then the way that this works is we first remove all of the accumulated depreciation that has been incurred. So we've got accumulated depreciation of 4.2. It's a contra asset, it has a normal credit balance, so to get rid of it, we debit it. Get rid of all the accumulated depreciation. And then we'll credit the asset, which was a plant, or the sum of our two debits. So in the last problem, they didn't give us accumulated depreciation, so we couldn't include it in our journal entry, but this is the more appropriate journal entry. You have to remove the related accumulated depreciation along with reducing the value of the asset.
That's all of the accumulated depreciation.
Say again?
It's all of the accumulated?
All of it, related to that asset, yep. It's like we're starting over. And then requirement 3. Repeat requirement 1, assuming that the estimated undiscounted sum of future cash flows is $12 million. Our book value was $18.3 million.
Worried because it's still less. I think I don't
My
understand.
notes are wrong. My notes say that the sum undiscounted cash flows is 19. It changed the book on me, or either I got a typo. So my notes are wrong, but let's do this thing the right way. Is the undiscounted sum of future cash flows less than book value? Yes, so we move on to step 2. Didn't tell us anything about step 2, so our impairment is the same. Whatever, that was a dumb one. Alright. Last topic I'll ever teach you. Goodwill impairment. Um, 1131. Goodwill must be tested annually for impairment. So with our fixed asset impairment, we only have to test if there's an event or circumstance that leads you to believe that the assets might be impaired. But with goodwill, GAAP requires you to test it for impairment every single year. It also used to be a 2-step process, but not too long ago, GAAP changed, and it's just a 1-step process. Is the fair value of the reporting unit less than book value? It's a 1-step process. 1131, it says, in 2019, Alliant Corporation acquired Centerpoint Inc. for $300 million, of which $50 million was allocated to goodwill. At the end of 2021, management has provided the following information for a required goodwill impairment test. The fair value of Centerpoint Inc. is $220 million. The book value excluding goodwill is $200,000, and the book value including goodwill is $250,000. We're not going to use the number in the middle, book value excluding goodwill. We used to, and it was a 2-step process, but we no longer look at book value excluding goodwill, so that's irrelevant. We're looking at the fair value of $220 and the book value of $250. Is the fair value of the reporting unit less than book value? Yes, therefore we have an impairment. Or the difference of $30 million. Our journal entry is to debit goodwill impairment loss. $30 million. And reduce our goodwill. Remember, we had goodwill of $50 million. We just reduced it by $30 million down to $20 million. Requirement 2. Repeat requirement 1. Assuming the fair value is $270. Book value is still $250. The answer is no, so there's no impairment. confetti should come down or something.
That's when we finish the final.
It's just confetti for me.
Yeah, for you, not for us.
Must be
Well, no,
nice.
you got one more after us. No confetti yet.
I know for a fact you're teaching this summer, so
How did we
Short-lived.
Class you asked.
Is it due by the?
So I looked,
Let's do.
I looked on D2L and the grades, and of the 38 students, 37 are actually participating. So I'll let 37 be your denominator, the kid who signed up who never did one assignment. All right, here we go. 74%, but with the denominator being 37, y'all got it.
Yeah, what?
So we get one,
One question.
so are you just gonna like, we get one wrong, you're just gonna make one
what
right?
part of this class?
Should tell us what it is about. It's gonna be.
You're at 75.7%.
Well, this is.
I'll never hit the 90 then.
It's due tonight or what
What's
is it?
the?
Well, so yeah, I guess tonight.
How many do you need for two questions?
You need, so 28 people have now done it.
I did it, by the way.
37 times 90%. You need 33 people to do it.
We're never gonna get that. You know, there's like a whole back row missing. There's even less people here today than there was Tuesday. So,
Alright, so I'll post that one question in D2L later
yay.
today. So look for the question, and then if y'all can get it up to, 90 the rest of the day, then I'll give you a second question.
Quick question.
So it's not just you get one wrong, you switch it around.
Very, worth nothing. By any chance, are you giving, what's your second class percentage? Just for giggles.
They're always